So let's just go ahead and get started. I'm here with Jim Devlin and Scott Ulnick of DuckerFrontier, a firm that we really respect a lot. I'm really excited to hear their read on what's going on in the world right now, particularly as it relates to private equity in the transaction world. I'm going to let Jim and Scott tell you a little bit about what they do, but the date right now is June 1st, 2020. We're several months into the pandemic right now, and I've always enjoyed meeting Jim and Scott on the road in normal times and hearing their point of view. So first, let's let you guys introduce yourself. Jim, why don't you start with you? We'll go to Scott, and then maybe we could talk a little bit about what DuckerFrontier does, and then kind of go into your read on what you're seeing right now. Jim, why don't we start with you?
Perfect. Jim Devlin. I'm a managing director with the DuckerFrontier Transaction Advisory Group here, based out of Troy, Michigan, but we have offices globally throughout the rest of the U.S., Europe, and London, and really focus our business on several different forms of market research as it relates to buy and sell side on transactions, as well as portfolio support across about 5 core verticals.
Yeah, and we'll talk about those verticals in a second, I'm sure. Scott, how about you?
Scott
What's your
Ulnick,
background?
also with DuckerFrontier, been with the firm for about 25 years. Overall, DuckerFrontier is a research and advisory and consulting firm. We work both with corporates and portfolio companies on growth strategy, where to play, how to win type of scenarios, and as well, we have a transaction advisory group where we're conducting the diligence on the buy side and the sell side, as well as helping kind of map market opportunities, market segments, and subsegments of the market for transactions. Across a wide spectrum of manufacturing and healthcare, some of the subsegments and markets include automotive, both OEM and the aftermarket. We do a lot of work within building and construction products and materials, general industrial, which covers a wide spectrum of everything from material handling and packaging to HVAC to building automation and industrial automation.
Yeah, that's fantastic. We're going to have a fun talk today, I guess fun in quotes, but I'm sure your world just got turned upside down. As you know, we work with transaction professionals all around the country, mainly on the buy and the sell side. Maybe give us a read. I mean, you were doing market studies let's kind of focus in on the buy side, where a lot of our relationships are. Can you give us just an overview of, what happened when when the world started shutting down and what's happening now? Scott, let's stay with you and we'll go to Jim.
Okay. So to focus on the buy side, starting in probably the second week in March, when there was an understanding that this is a big deal with COVID and what was happening, we saw pencils down. We were probably working on a dozen engagements on the buy side. Our engagements typically last 4 weeks, where we're looking at market, customer, and competitor insights. And whether it was being run by a formal process or our guys were in there on the buy side on their own through a founder-owned business, whatever it might be, they said, "Listen, this is starting to look like it might be something more than we expected," and they went pencils down on a lot of transactions. That's probably a month. That's probably 2.5 months. When that first started, we've seen a few of those pick back up since then, just in the last 2 weeks, where, okay, we're going to start looking at this again, and the deals are back on. We have seen quite a bit of the financial sponsors, the private equity community, where they have flexibility to focus on loan to own, so to speak, scenarios. So we see a lot of the private equity guys looking at distress, but looking at debt to equity type transactions. And there's a dozen of those firms where we have good relationships where, they call it being an offense, but they are seeing this as a real opportunity to go out and look at things. So we're looking with 2 or 3 firms where they have anywhere from 75 to 100 targets that they've been looking at that are quote unquote distressed in various sectors. But some of the key gating items that they're looking for is this a good business that COVID is going to be needed? So a lot of infrastructure services, a lot of different industrial products, restaurant products. We've seen a lot of activity around those spaces. So slow. Most of April and halfway into May was very slow on the buy side. We can talk about the sell side in a little bit, but we're seeing the activity pick up even on pure play buyout transactions.
It's kind of crazy because when our clients, we're talking today about what they're thinking about buying and getting back in the market, but you also have to talk about their existing portfolio companies and the ones that they had to triage. And it's interesting, I'd love your read on it, but we've had our private equity relationships tell us, like, I have to tell you, it hasn't been all bad. We've had some winners that we didn't expect. We've definitely been some losers, the things you would expect. Anything has any type of, retail and that type of thing. But there have been some infrastructure winners and people that have their supply chain figured out. It's been interesting. But Jim, maybe you could give us your read, about what Scott said and what you're seeing right now.
Yeah, no, I think certainly from an infrastructure perspective, everyone is looking forward to hopefully in phase 4 of stimulus, where we're looking at additional funds that are going to be able to facilitate a lot of that. I mean, just on a micro level, we're seeing a lot of construction activity from a municipal standpoint increasing because there's nobody on the road in the Detroit area.
Right.
When we start talking about distressed credit facilities, I think there's some obvious losers in the space. There's some obvious areas where folks that were already distressed, you saw the retail bankruptcies that have been happening. But now it's a matter of how do we figure out and start to study and start to really get some deep knowledge into some of the participants that may not be distressed right now, but they will be in 4 months. And so different than a lot of our historical work where we're able to take 10, 20 years of historical data and apply a regression and understand where the dips are going to be. We're going to be looking at 4 months if there's a second wave in November and saying, okay, how do we understand relative to also the stimulus that's entering some of these businesses? How do we understand who's really going to be distressed and who's going to come out on top from not only a commercial standpoint, but also a footprint standpoint and an overall operational standpoint. So those are some of the things that we're looking at across a lot of different industries.
Do some of the financial buyers come to you and say, are they commissioning you guys now to look ahead in that 4 or 6 month time frame? Are you getting work doing that right now?
Absolutely. It's been somewhat of a pivot in our business in terms of traditionally we're not a subscription model where we're a custom work model, but we're looking at what I would essentially term mini modules of getting up to speed very quickly, because there's not going to be traditional auction processes. These are things that you're going to need to get in, whether you're the stalking horse or whether you're negotiating directly with the current lenders. These are things that are going to come very fast, and it seems as though there's a group of CEOs and CFOs that are preparing for some of their debt that's coming due, but there seems as though there was a large group that over the next 3-4 months is going to have some serious negotiations ahead of them.
It's interesting you talk about the speed, because pre-pandemic, we talked to a lot of financial sponsors that were either thinking about doing a fund or doing, basically a fundless sponsor where they just, grab the capital from their interested investors. And always the argument against doing, the SPVs, the special purpose vehicles, was the speed. You can't if you have a fund, you can move faster. Is what you're saying, you're kind of thinking that folks that have the capital ready to go, have a quicker decision process, might have an advantage? Is that what you're saying?
Certainly. You know, it's an interesting point, because all of the historic data has shown us that funds that have a origin around the time of the Great Recession did better, higher returns overall.
Interesting.
This is a different play in terms of, and we're not capital markets guys, but this is a different play in terms of there's a lot more liquidity in the stock markets. I mean, we're still at the Dow is still 3 times the level it was at a low in 08, 09. And so there's a lot of corporate liquidity at the same time, and a lot of folks that are going to be fighting for the same deals, because I think everyone's taking a mature outlook on it and saying there may be, I'm not going to have to pay 10, 12x. I might be able to pick up some things at 4 or 5x, or to Scott's point, I may be able to find some areas of debt to equity conversion that are very attractive. You saw in the markets just recently, I think Apollo in 4 weeks raised a $1.7 billion distressed credit fund. So opportunistically, yes, some firms are going to be limited and not have that ability to pivot just based on their charter. But I think the LP community is also going to be less afraid and more hungry for transactions during this time, given what they saw 12 years ago.
And just to add to what Jim is saying, what we're seeing is private equity to be on offense. So speed to look at an asset, but we also see them taking not one at a time, but saying, we like these sectors. Here's 10, 15 companies in each sector. And they're grooming. They're in contact with executive management. They know that they're either in trouble with debt or they're likely going to be as time progresses. So they're getting in early and asking us for the information so that they're smarter on the sector. There's some key items that we can answer fairly quickly. Historical information is no longer valid. You need to understand by doing some of the direct primary work and modeling that out, how they're going to fit into the marketplace, how their supply chains are going to work, how their customers are positioned, is there room to gain share? And we're also looking at a lot of adjacencies. But the point being, we're constantly feeding them information, and it is competitive. We've talked about how competitive these deals are for guys that are in the marketplace. So speed is important, but being up to date on the market and where it's going and where target companies are going sometimes brings an advantage to the client that is armed with that information during the discussions. So they're counseling, they're advising, they're talking about where the market's going and why they think they can help these guys, brings kind of advantage to them versus we just have capital. We have access to capital for you. Yeah,
I mean, that really brings into focus how valuable and great your service is. I mean, because when you think about it, when you're doing a one-off acquisition, we have a transaction advisory group. It's great. They do the quality of earnings, engagements and that, but yours is such a much more broader, much more well thought out, view of what's going on. And when the world's changing like this, that's one reason I reached out to you guys, because I just felt that what you'd be doing, you're just right on the firing line of the thought process of how people are reacting to this. I think it's fabulous. One thing we've seen is that LPs, limited partners, have been over the last several years, they've been much more savvy and as they're relating to provisions and the agreements with these financial, private equity firms. They've been negotiating tighter deals, getting more involved in the decision-making process, to the extent they can, because they are limited partners. So I think that dynamic is going all the way up. And the truth of the matter is, these private equity firms, they have to get the capital out. They just can't sit on it. They've got to be in the game, and there is a lot of pent-up demand. Maybe we could talk a little bit about, and we can kind of, as we're finishing up, maybe give you a read on the industries. I mean, I've probably talked to 50 private equity firms in the last 3 weeks about, and some of them have specific industry focuses, but you guys are really seeing industries in a different way. which ones do you think are the ones we ought to be looking at? Which ones do you think are it's going to be a while before they return back to any kind of normal? But maybe give us your industry synopsis right now in a very broad way.
Yeah, I would break it into two categories. One would be good businesses that are distressed right now, but are going to come out of this and be okay, whether it's a V or a U or however. And some businesses are in trouble based on where they are. You know, the digital readiness and these types of things in terms of just traditional industrial companies is part of what we look at in diligence. But just to read off some of the sectors that we're seeing that are kind of growing and being invested in, air quality type stuff, sensors, safety products, certainly the automotive aftermarket and automotive repair. And one of the trends that we're seeing coming out of China and now even in Europe is mass transit. People are afraid of it. So automotive, and in particular the previously owned used car market, people are pretty excited about that and the opportunities that it's going to bring for private use vehicles, which helps automotive repair, the automotive aftermarket as things come into play. So seeing an awful lot there. Commercial services, food equipment and repair, elevator repair, fire and safety, monitoring, disinfectant services for institutional food manufacturing, general industrial, residential, environmental services and testing, fire suppression equipment, very, very hot right now.
Really? Wow.
Waste management, all kinds of residential services, HVAC, plumbing, appliance repair, landscaping, pet food, treats and products. People love their pets and they're home with them more.
Doing landscaping and
gas,
repairing their
propane
home,
gas,
right?
all kinds of stuff around propane gas is hot. Clean services and remediation and those type of things, very hot. Jim, you can probably talk to some of the healthcare, but professional counseling, certainly executive, family, marital, all those types of things. But then some of the healthcare segments are pretty hot right now.
Yeah, there's certainly a switch on the healthcare side in some of those segments to telehealth. I don't think that's any secret relative to the news that's come out. I think when we also think about these businesses, you say what's essential during COVID, but what's essential coming out of COVID. So some of those guys have been flat to stable, and that's going to continue. I think there's another subsector of businesses when we think about it. It's everyone is going to come out with some level of pent-up demand. How long is that pent-up demand? And when that does stop, where are we looking at? Take residential construction. Residential construction is going to come out, and all the subcontractors are going to have a lot of business over the next 4 to 5 to 6 weeks, because that's all zoned. But at the same time, for the last 2 months, whether you're talking residential or commercial, all of the offices that zone and permit all that activity and all the large companies that drive a lot of that have either been shut down or have pulled back on their plans for the year. So what happens when we get to that cliff? Now, there's a lot of mitigating factors when we talk about that, because if you look at residential construction and you look at stock and how that's grown over the last 12 years, population has outpaced that. And so there's a need in the market for that activity. It's going to be a lot of push-pull. There is going to be a few more months of pain in a lot of these industries, we feel. I think when you start to talk about industrial distribution, it's a whole different ballgame than a lot of the building products that we would talk about, because those industrial distributors are then serving an auto market that is coming on and offline in some cases, or they're serving other industrial light manufacturing. And so we start to think about sources of supply, and all of that has been disrupted. So I think we have some bumpy months. I think as we all come out of this, I mean, Michigan is slated for mid-June for some more openings. I think we're going to see definitely some bumps over the next call it 3-4 month horizon, but the first 2 months coming out of that, we're going to see some very high levels of activity. That's going to help optimism. It's going to, and regardless of whether optimism translates to financials, it's going to help
Right.
morale, and it's going to help boost. And really, it's just figuring out what the plan is for this. For this next 6 months, 18 months. And that's a lot of what we've been asked to do. When we're asked to do a forecast right now, that might change by the day.
Sure.
So when we're proposing on activities like that, we're saying, you know what, let's just all be mature and say, we'll update this forecast when it makes sense to do so. And I don't think anybody has a crystal ball on that.
Automotive OEM is something that, it's gone from auto production, 17 million unit build and SAR to 12 or 13. If you talk to the pro forecasters in terms of what's going to happen, but you got to look at the segments and the vehicle segments and the supply chains and opportunities that are within. So if you're on the right programs, pickup truck, for example, they're the same as they were coming into COVID in terms of forecasts.
Mm-hmm.
So whether it's for contractors or construction or just people, the pickup trucks, you can't make enough of them. Right platforms with the right supply chain, there's investment opportunities that people are pursuing in that area.
And Scott, you had mentioned also some of the auto aftermarket activities, and yes, residual values are going to be down coming out of this. There's OE incentives that are coming into play to buy new, great. But at the same time, we haven't seen what the reverberations of the Hertz bankruptcy are going to be. I mean, you're talking tens of thousands of vehicles that are going to be entering the park as for private use, and it's. I think we have a lot of wait and see relative to that.
To me, and I know we need to wrap up, but I just can't imagine why a financial institution or a private equity firm wouldn't want to retain you guys to be looking at this, because in a world I know
we're putting you on the website, Bob.
I hope so, but especially in this time, for example, our consulting division is just so slammed right now, helping companies think through the new normal. And in fact, I need to introduce you guys to them, because I think that, to have smart guys like you and your team and already having a methodology of understanding market movements. I think I know this conversation was very general, but I think it's very instructive and illuminating in many ways. So I just appreciate you guys spending time with me. And I just think what you do is timely, unique, and it's going to be fun to stay in touch with you guys during the course of the year. And, with your permission, I'd love to check in with you again for an update sometime. I think that'd be great.
Absolutely. It's fluid, as we said, but thank you for the collaboration. I think we met a couple of years back at one of the ACGs in Europe, and we appreciate the relationship, really do.
Thanks for listening to one of Frazier & Dieter's branded podcasts. To learn more, connect with us on LinkedIn or visit us at FrazierDieter.com, and be sure to subscribe so you never miss an episode.